Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. It's Tuesday, the 2nd of November, and today we have James Whelan, the investment manager, head of the VFS Group Global Macro Fund, who's coming out of Sydney. James, welcome to the show.
Great to be here, Brian. How are you now?
Good, thank you. Now, James, before I get your insights, we're gonna take a look at how crypto markets have performed and also how regional stock markets have performed. We're going to start with Bitcoin, which is at 20,524. It's up 0.14%. Ethereum is at 1,590. It's up 0.07%. Now, looking across the regional stock markets, we start with Singapore. The SGX is down 0.22%. We've got Bursa Malaysia, which is up 0.03%. Shanghai is up 1.06%. The ASX All Ordinaries is up 0.19%. The Nikkei is down 0.1%. The Hang Seng is up 2.11%. And rounding up the numbers, we've got the Kospi, which is up 0.01%. Now, James, what's your view on how markets have performed in the first half of the day?
It looks like everything is sort of in two minds at the moment, Brian. On one hand, we've got one of the biggest Fed decisions of the year, if not in the last couple of years, coming up at 5 a.m. tomorrow morning, Sydney time. I'm not sure that's 3 hours behind Singaporean time. That's going to be the Fed deciding, or at least the Fed speaking, absolutely, almost certainly going to be announcing another 75% rate hike. But all markets on tenterhooks currently waiting to see if there's going to be any messaging out of Fed Chair Powell as to whether they're going to be slightly less hawkish or even, God forbid, dovish on some of their messaging with regards to rate rises going forward. Will they be acknowledging where inflation is actually going to be going? Will they actually start to maybe tone themselves down a little bit with their hawkishness on going into 2023? The market is currently waiting on that. Anything that's outside of that, so if it's ultra hawkish as usual, the markets will probably have a bit of a drop off, and we might see the rally of the last couple of weeks start to be erased. If it is anything that is slightly less hawkish, or even a 50-point rate hike, we may see the market absolutely ramp up, and potentially some people are speculating that with the midterms in the US next week, potentially maybe see another 10% rally onto the US market. At the same time, Brian, we've got rumors out of China about reopening, conflicting with what we're seeing out of China with shutting down over COVID outbreaks as well. So right now the market is sort of in a little bit of a hiatus. Locally, the Chinese rally has been an amazing thing to see on currently unfounded rumors, but we've also got this big risk event only in a couple of hours away in the US. So everything's sort of on hold at the moment.
So, James, talking about dovishness versus hawkishness, we see the dichotomy with the Reserve Bank of Australia and the Reserve Bank of New Zealand. So the Reserve Bank of New Zealand obviously has hiked up by 75 basis points. In the last rate hike, Australia just hiked up by only 25 basis points. What's your view on this? Is that more to do in Australia with the Reserve Bank being worried about the housing markets and Australian consumers as a whole?
It would seem that a lot of what the RBA is doing is based on concerns with the housing market. What we're seeing here in Australia is that we've got consumer sentiment is actually going down. So that's coming off. So people's outlook on the economy is coming down. However, retail spending has shown no sign of actually slowing down. People are still ramping up their spending. If you want to put it jokingly, Brian, I suppose you could say it's like in Sydney, we see restaurants absolutely packed out. You can't get a booking in Sydney restaurants, full of people all complaining about how bad the economy is. Something's got to give here. However, in the face of that, that the RBA not raising by 50 basis points anymore, it seems like 25 basis points is the way forward for them. And it seems like globally that's sort of started a bit of a trend that maybe people are seeing that the RBA is starting to lead the way for central banks slowing down rate hikes. And the way that the markets are poised at the moment, a decreasing in your rate hike is now being seen as good as a rate cut when it comes to markets and stimulus. Whether it's the right choice or not, that's not really up to me. But yeah, it does seem like it's based on where housing is going. And housing hasn't really corrected that much in Australia. It has corrected, but it was very, very bullish over the last couple of years. But it has come off, and it seems like people are really worried about that. We've got a lot of people in Australia rolling off their variable mortgages onto rolling off their fixed mortgages onto a variable rate. That big jump is going to hit, and it's hitting hard. It's hitting now, it's hitting next month, and it's hitting in the month after. That's something that the RBA is very concerned about as well.
And then, James, then what's the impact then of this on Australian equities? Are there some sectorial gains in certain industries, particularly in commodities-related industries?
Well, if we look at the commodity space, that's going to be about the Chinese story at the moment. We've seen that iron ore prices haven't really moved today as much as, or last time I checked, at least they haven't. But iron ore miners absolutely have. We've seen BHP, Fortescue still going up on the basis of the reopening moves in China. So reopening rumors, I should say. Really have to specify. There's absolutely nothing foundational behind this at the moment. So the Chinese reopening story is driving our commodity side that's here. What we are seeing is that our retailers here, so everyone else, seems to be doing quite well. The banks are a fantastic place right now to look. We've seen some good rallies out of them paying enormous dividends, and also their NIMs improve. Sorry, their net interest margins, I should say, do improve when interest rates go up. And with an easing on rate rises, it seems to be sort of the perfect place for the Australian banks to be at the moment. The commodities is going up based on the China reopening. I'm really keen to get into that with you as well.
Now, James, before we get into that, this China story, does it have legs?
It has legs in that it makes sense to think that eventually China needs to reopen. So yes, eventually you will see a headline like this actually officially come out from China, from an actual department, as opposed to as it is now. It just seems like it's a lot of rumor, it's a lot of scuttlebutt. The word on the street here, Brian, is that potentially this is Western funds who are still trying to exit their Chinese position, and this is their last chance to get out, and they're using this as a chance, or they've stoked this rally and fueled this very plausible rumor out of China as a means of being able to exit their positions. Based on what happened at the Congress a couple of weeks ago, at the Communist Party Congress a couple of weeks ago, we've seen that China has started, or Chinese equities specifically, have become less of an investable case for Western funds. You're not entirely sure what you're getting into, government control, sort of more of a totalitarian feel to it with the new Chinese move over there. Also, the fact that you don't have any real relaxation officially made, no moves have officially been made from China on the relaxation of COVID. That's something that needs to be paid attention to. So Western funds are sort of starting to think, or at least they have been, which is part of the reason why China has sold off so heavily over the last couple of weeks, that you can't be invested in those stocks over there. It's great for the derivative of Chinese reopening, or at least Chinese on the move, as we've seen, BHP, Fortescue, iron ore here, the miners and copper are starting to recover. But for actual Chinese stocks, you can't. Potentially, this rumor has just been manufactured just for people to be able to exit their positions. But eventually, Brian, China will release a message like this saying that they are reopening and that they've got a reopening committee. That's what that makes this so believable. However, until it's done, until you see it, or until you hear it said, it doesn't happen. It hasn't existed yet, because right now they're still locking down cities, locking down Disneyland. We've seen an iPhone factory get locked down. That's actually happening. So until we see the reverse of that, you can't say that the Chinese reopening is in play.
Now, James, thank you very much for coming on the show, and thanks for your insights.
No problem. Have yourself a great afternoon.
I'm Brian Fernandez, and we've been speaking to James Whelan, investment manager and head of the VFS Group Global Macro Fund, on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. This video and podcast will be on our website, www.biztech.asia, as well as our social platforms. It will also be on our syndication partners, TV stations, radio stations, and websites. Thank you very much for tuning in.